And welcome back, everybody. Last session, we went over those KPIs. Today is cash flow, and it's a big one. It's my favorite because being profitable on paper doesn't always equate to having money in the bank. So, without further ado, why are we talking about cash flow today? Well, it's because you can't survive running out of cash. What pays the employees? What keeps the vendors happy? What keeps fuel in your trucks to go to the next job? So borrowing only solves that problem in the short term. You might think like, oh, we have a huge cash influx, we're fine. But ultimately, the underlying issue would still be there. So we want to find it, solve it, and ultimately end up like the business on the left, not the broken, rundown one on the right. And you might be asking yourself, hey, I'm profitable, but why don't I have cash? Or where does it all go? And like we kind of mentioned in session one, profit doesn't equal cash. And that's because of a few sort of leaks or things that happen on the backside where your cash disappears to necessarily. The five we're going to go over today are accounts receivable timing, if you're paying your bills too soon, your loan payments, owner's draws, and unplanned spending. Those are the five major ones that I see time and time again across the trades on where that cash tends to leak to. Okay, so now you may be asking, like, all right, how do I find where this leak is? Well, you want to start with your statement of cash flows. And a pro tip, so on the right here, this is your statement of cash flows in a visual way. It's called a cash flow waterfall, and it's my favorite. I am a visual person, and this helps me tremendously see exactly where the money's coming in, right? Cash in and all the cash coming out. So with your statement of cash flows, you should be reviewing this monthly. You'll see it on your monthly statements. You're going to be looking for where does my cash flow go negative? And what it's going to tell you is it'll give you the big picture view of where your cash is going. So in the top, we have your operations cash flow, we have your investing, your spending, and we have your financing cash flow. So it'll give you an idea of where within your business that cash is disappearing to. So this is going to be your diagnostic cheat sheet. If you're ever unsure why cash feels tight, this is where you should start, the cash flow statement. And so what are you going to look at on it? So the first thing I want to look at is the accounts receivable, and that's here, right? So change in accounts receivable. You can see this particular example is negative 6,000. So they basically pulled in 6,000 of their accounts receivable. Their accounts receivable decreased. They don't have that available cash anymore. And now the next thing you do is like, okay, if you isolate that on this statement of cash flows, you want to go look at your AR aging summary, and you're going to look for invoices that are basically overdue. If your any invoices are over 15 to 30 days, it's telling you that you're being a bank. Customers are holding your cash, you're giving them an interest-free loan. The next thing you'll do is you'll look at accounts payable. So the way if you see that that's your issue on your statement of cash flows, then you'd look at the accounting report, your accounts payable aging summary. And again, everything is paid up, you don't have any bills, you're absolutely perfect, well, then you're probably paying too fast. You're not leveraging your vendor terms, right? If they're giving you net 30, that's a 30-day free loan, more or less. You should be leveraging that, especially when you have cash flow issues. You shouldn't be paying them the same day if you have those net 30 terms. The next you'd look at is your change in liabilities. So we have current liabilities here. That's going to typically be like a credit card. Current meaning that it's going to get paid off within the year. It can be a short-term loan as well. And then non-current liabilities, those are going to be your bigger ones. That's going to be like your really multi-year loans, like fixed assets and things like that. And these ones are really sneaky, right? So typically, if you're just looking at your P&L, your profitability, well, the only thing related to loans on there is going to be the interest that you pay. So that's where you can be profitable, but still have a huge cash flow issue because you're paying a whole bunch of principal on the back end. And so if you see that your liabilities are your cash flow leak, you would check your balance sheet, and you should be looking at this on a monthly basis, but you can look at it month by month and see, all right, where's my debt increasing? And ultimately that's going to tell you, all right, cash is coming out of the business on the back end to pay for all this debt, loan, principal. The fourth thing you'd want to see on this statement of cash flows is your change in retained earnings or equity. This is ultimately going to be your owner's draw. That's just the fancy accounting terms for it. And what you're looking for is owner draws to be increasing or irregular. So if you don't have a plan set up for when you're withdrawing your owner's draws, the months that you do a huge withdrawal or the months that you're irregularly paying yourself, that can hurt your cash flow and you ultimately result. So like in this example here, everything looks pretty good, right? We have operating cash flow of 222,000, free cash flow, nothing really changed too terribly much. And then the owner took $200,000 withdrawal, and that was what resulted in the negative cash flow that the business saw. So they had a profitable month, and then the owner took all of the cash out of the business, and that's what put them in the bind in this example. And then fifth, last and not least, is the unplanned spending. So the tricky part with the unplanned spending is that you can't see it on the statement of cash flows. It's going to be wrapped up into your cost of sales, your expenses. So the only way to really take a look at that is to look at your profit and loss on a monthly basis. So on the monthly basis, if you see it month by month, or if you're looking at the variance relative to your average every month, you're going to be looking for declining margins or revenue. If that's your case, say it's the slow season, then ultimately your sales or your cost of goods are the issue that's impacting your cash flow into the business. So that's a separate problem that's more towards profitability, but it will impact cash flow. If that's not the issue, do you see any big or irregular outflows in any account? So do you have a huge expense somewhere for some reason? And is that because you had an unplanned purchase that wasn't budgeted or forecasted into your cash flow? And that's ultimately the cause of draining your liquidity. So this is what you should start with cash flow wise. That statement of cash flows, that's how you use it. It's not just in your monthly reports for no good reason. So how do we fix it? Let's start with the first one. So accounts receivable. So like we said in the diagnostic benchmark, you're looking for at your accounts receivable aging summary report. You'll find this either in QuickBooks, depending on how you're set up. It might be in your field service software like Service Titan, House Call Pro, Jobber. But ultimately, who owes you money and how long have they owed you that money? Ideally, we're trying to collect within 30 days, if not less than 15. And if you're over that, then you're going to have some problems. That's ultimately just you're not bringing in the money to be able to use that on the backside to pay all of your expenses, payroll, vendors, etc. So then how do you fix it? Well, there's a few options that I like to use. One of them is to look at the payment terms for your accounts receivable. Are you offering your customers net 30 payment terms? Can you switch even just the residential work to like a due on receipt or a net 7? A lot of the new technology now and what seems to be common across the industry is enabling that sort of due on receipt by collecting before you leave the job sites. So you do that, with tablets, mobile phones, card readers, etc. But enable your techs to be able to do that due on receipt. Don't make it a pain point or a challenge to be able to enforce that due on receipt. For large jobs, say installs or really large commercial work, rather than you fronting all the expense for the equipment, are you collecting deposits for those jobs? It's a thought. It can help definitely on some of those larger jobs. And then you can consider adding late fees to try to enforce, the 45, 60 plus day accounts receivable. It can encourage payment. Typically, however, consistency is going to improve your collections more than policy. So just following up on a regular basis is typically better than adding just late fees because people aren't already looking at it anyway. The next thing is automation. So again, with your field service tool, are you sending email, SMS reminders at 7, 14, 21 days, weekly to say, hey, your invoice is overdue, your invoice needs paid? Or at a minimum, if you don't have the technology, do you have an employee that is on their weekly task to look at accounts receivable and send the emails to those that haven't paid? And then financing and payment plans. So back to sort of those large jobs again. Do you offer financing for large installs to get paid earlier? That can be appealing to those who the customers that don't have the cash, need the work, want to work with you, but don't know how to get it done. So that can help bridge that gap. And then on a workflow basis. So how often are you looking at your accounts receivable? So again, back to consistency improves that collections. Review your accounts receivable weekly, not monthly, and make sure that if your accounts receivable was above whatever threshold for your company, 15, 25, 30 days, that you're triggering a same week call. Somebody is following up with them. More than just an email sometimes can make the world of a difference. All right, next one, accounts payable. So back to that diagnostic cash flow sheet. So the accounts payable aging summary is the sub report we're going to look at. And we're looking at, are all of my bills already paid? Did I spend money and I paid it right away? I didn't use any credit. Well, what we want to strive for is pay as many vendors as you can as late as possible within terms and without missing discounts. So if you can kind of think of it, we have accounts receivables, all the money coming in, and then accounts payable is the money going out. We want to collect the money coming in as soon as possible, and we want to delay spending money as long as possible. That gives your business the largest buffer of cash possible. So how do you do this? Well, review the terms you have with your vendors, especially your main one, right? A lot of you have, 1 to 5 sort of major parts vendors. Check what the payment terms are there. Make sure you're maximizing those within the terms and the relationship as much as possible. And don't pay early unless discounts apply. If you're getting a 2% discount to pay within 10 days, by all means, take advantage of that if your cash flow allows. But otherwise, net 30, don't pay until 30 days. Keep that cash in your business. That way you have the buffer. And then in some instances, especially where you have a good relationship, you spend a lot of money with the vendor, you can ask suppliers if longer terms can be arranged. And those longer terms might even make sense for just the slow season. So if that can be possible, it can help fix cash flow gaps for you. And then I like to schedule and batch the payments. So once a week, right, I'd go in and do the accounts payable for companies. This helps because we can organize all the bills to go out at once, and it helps us prevent random cash outflows. We can plan, we can improve the visibility of the payments, and with that cash flow forecasting is so much easier because we look at, hey, this is the balance, this is all the bills we need to pay this week, next week, the next 4 weeks, and we can plan the future, what that's going to look like. And then ideally, again, sort of back to that, how do accounts receivable and accounts payable play nicely together? At a minimum, we want to align the accounts payable with the accounts receivable timing. If you can be better than that, ideally accounts receivable is faster than accounts payable. All right, the third one we talked about, debt. So you're going to look at the cash flow statement. You're going to look for a large impact from either the current or non-current liabilities. That's ultimately going to be, hey, I paid a whole bunch of debt down. And then we're going to try to understand where that debt is. You'd go to the balance sheet and say, okay, this loan, bada boom, bada bing. Now, what you're looking for is your debt payments, your principal plus the interest plus whatever extra principal you're paying should be less than 10 to 15% of your operating cash flow. Now, how do you make sure that happens? So first and foremost, you're going to review all of your debt obligations. So know what your monthly payment is, and then check that against your average operating cash flow. So again, the loan cash flow is principal plus interest plus whatever extra you're paying on it. And then compare those total loan costs, this total loan cash flow, to the monthly operating cash flow. And this, you should understand what this number is before you start adding more and more loans to the business, because you can ultimately get a loan for more cash, and then you'll have a whole bunch of cash at one instant point in time. You'd spend that, and then you just be left paying that bill for a long period of time, choking your cash flow on the back end. Be careful paying off loans too quickly. So especially if you have cash flow issues, especially if you're trying to keep your everything working from a cash flow perspective, paying your loans off faster can save you on interest, which is great, but it'll choke your cash flow on the back end if you haven't planned for it. So ensure you have your cash reserves built up first. Make sure you have, your 1, 3, 6, whatever months of savings built up before you pay off your debt. And then if you have too much loan cash flow impact to your business, consider refinancing. You can strategically refinance those loans to get into smaller monthly payments where cash flow is no longer an issue. Yes, you'll pay more in interest typically, but cash flow is a lifeblood. You don't have a business if you can't pay your bills. It'll ultimately not work. All right, fourth and not everybody's favorite, This one probably hits a little close to home, is owner's draws. Yes, we want to pay ourselves, but we have to do it without starving the business. So again, back to the diagnostic, right? We're going to look at the cash flow statement, check that equity line item, see if there's any large outgoing sources of cash. Check your monthly balance sheet. Look at the, by month, January, February, March. See if that equity outgoing is consistent over time. And we need to make sure that the owner's not drawing more profit or more from the business than the business is making profit. So you shouldn't be exceeding roughly 80% of monthly net profit at max. Those with larger businesses, that number can get smaller because you have more overhead, you have more growth planning, etc. At max, it should be 80%. That leaves at least 20% for growth. How we fix this? So we want to separate the business and personal accounts. So I see this way too often. It's annoying carrying 7 credit cards. But it is important for accounting, especially when we're trying to diagnose some of this stuff, is that ensure your draws and your payroll are the only way you're paying yourself out of the business. So don't go to Chuck E. Cheese's with your kids and swipe that company credit card. That personal fund contamination just is really difficult to make these owner draws consistent. And then the next thing is set up a plan. So look at your historical data, set up a realistic pay plan based on what you're actually making, the business is actually making, and then make sure you include seasonal swings into that. So you shouldn't be paying yourself more than last month's net cash flow. You shouldn't be paying yourself more than the average cash flow. And if that's difficult or you just are more of a visual budgeter, look at a profit first. So I love profit first because it can give you those visual allocations, right? You're going to set up 5 bank accounts where you would be able to see, all right, I have $5,000 or $15,000 in my owner's account. That is all I can withdraw. There's no like, oh, hey, I have 200 grand in the checking account. Well, that's all business cash, and you have a $200,000 credit card payment. There's not owner there. So you'll be able to see that visually with the profit first. So it'll help you visualize what funds are actually available. All right. Last but not least is that unplanned spending. So again, we can't see this on the cash flow statement because it's going to get lumped in with your just normal operating expenses typically. So the best way to look at this is to look at your profit and loss on a monthly basis or look at your profit and loss balance, like your variance on a monthly basis. And so you'd be looking at, all right, this account had an extra 5,000 that normally isn't in there or isn't in there on average. Why? You can also see that on the balance sheet. So if your unplanned spending involves purchasing large vehicles, cash, you'll see that on the balance sheet, not the profit and loss. So your goal is no unplanned spending. So ideally, if you're having cash flow issues and you have unplanned spending, you want to make sure that you budget it, you forecast it, and that everything you are buying has a business use and was in the budget. And so there's a couple options depending on what your spending situation is. Say it's your employees that are buying business things, but they're not necessarily planned and you're having cash flow issues. You can implement spending rules, whether that's $100, $250, $500. If they're spending that outside of specific parts vendors, make sure you're getting like an owner manager approval. That just gives you an extra step and visibility before the purchase actually happens. Make sure you're reviewing those expenses regularly. So back to the profit and loss on a monthly basis, just give the column, the sheet, a quick scan. Make sure you know, or at least are seeing what the average expenses are relative to what you spent that month. And some really easy ones to overlook, especially in today's day and age with all this new software, AI, fun things. Look for unused software and subscriptions. You might have tried something, forgot that it's there, and you're getting billed on a recurring basis. Easy one to fix there. Look for redundant tools, redundant tool purchases, or even overlapping services. How many marketing firms do you have? Are they all doing the same thing? Can you bundle and save kind of thing? So again, those are easier to see with proper expense categorization on your P&L, but ultimately that's what we're looking at. And then build accountability into the finance system. So look for the spending by department, by truck, by technician. You can really drill down sometimes to figure out where the spending leak is happening and then understand how to solve that problem there. So you're looking for the outliers in the business. A fourth option, you can also give yourself, if you're the problem, if you're the one spending kind of unplanned, you can budget for it. You can give yourself a budget of, hey, I can spend $500 a month on discretionary or things that improve my life as a business owner, things that help the business move forward. But if as long as you're working within a budget and that budget's in your cash flow plan, then it's a lot better than completely unplanned spending. So putting it together, right? If cash is tight, unpredictable, or stressful, no. All right. You don't have cash flow issues. Do what you're doing. It's working. But if you do, check your accounts receivable. Are your customers paying on time? Check your accounts payable. Are you paying your vendors too early? Check yourself. Are you the cause of the cash flow issues? Check your loan payments, and then check whether or not it's random purchases. So those the steps you're going to walk through, and you're going to use that diagnostic checklist to make that happen. All right. So then let's say you fix the actual leak. Well, how do you continue to keep it fixed? What you should be doing is a weekly review. This should only take 15 to 20 minutes. It'll take a little longer to set up initially, but once it's there, 15, 20 minutes max. And what you're going to have is a cash balance forecast that is forecasting the next 4 to 13 weeks-ish. Within that forecast, you'd update your current bank balance. You'd forecast what your expected inflows are, your expected outflows, and you compare that actual cash to expected cash. So your goal with that forecasting is that you're never surprised by payroll or major expenses and that everything is planned. And then as part of that, you should also be reviewing the accounts receivable and accounts payable. So again, that's the lifeblood of your business. How much money's coming in, how much needs to be spent. So make sure that that process is happening accordingly. And the key here is cash flow. You can fix it once, but you want to continue to make sure it's repeatable and it's predictable. So you want to review it, adjust, forecast, repeat. It's a cycle. You have to continue to do it, make it a habit. And then monthly, again, you get that monthly P&L, check your P&L with the spending, and then future planning. That's back to that 4 to 13 week forecast. Eliminate those unplanned purchases. So make sure that large purchases, acquisitions, new loans, they're all analyzed against your current future cash flows and your seasonal downturn, and make sure you have the budget for it. And now this doesn't have to be fancy. You can do this with Google Sheets or Excel, and it's probably the easiest way to do it. You don't need fancy software. You probably already paid for the software. The tricky part is setting up, creating a template, and then actually doing the work, populating it weekly so that way you can review that expected cash flow. So ideally, you're going to average those inputs, like I said, across 13 weeks. That way you kind of have an average, and even better, you can do longer and see what your seasonal ebbs and flows kind of look like. That's how you set up the forecasting. And then for the accounts receivable, accounts payable, you probably already have the software. It's either going to be QuickBooks or your field service management. You'll be able to pull the reports, the aging reports for both in one of those softwares, depending on your accounting setup. So your next steps, run through that diagnostic checklist, resolve any issues you find, set up the weekly cash flow routine, make sure you're reviewing those open invoices, reviewing the bills, and updating your cash flow forecast. And then monthly, just make sure you're reviewing your monthly financial statements. So the cash flow, the P&L, the balance sheet, and bonus points for adjusting your cash forecast based on what you're seeing on those. So I listed the benchmarks kind of that we talked about here on the right, but ultimately, that's the end of what I had for you guys today. So don't hesitate to reach out with any questions or comments. I'm happy to help.